Okay, ladies and gentlemen, welcome to our program today. Back by popular demand is Charles Wilfong, local tax preparer, and his presentation on personal income tax planning and the new changes that will affect your 2025 and 2026 income taxes. Welcome to those in the room and those of you on Zoom. Forgot to ask Charles, how do you want to handle questions from the people on Zoom? You want them to type in the chat and I'll relay?
Yes.
Okay.
That'll work fine.
All right. And those in the room, feel free to ask away at any time. All right, Charles, take it away. Thank you.
Hi, my name is Charles Wilfong. I have a local tax office down the street here. I don't know if you ever walked by it on Main Street. It says Wilfong Tax, Wilfong Law on the top of the building. At any rate, today I'm here to talk about the big beautiful bill, which is the bill that was passed late last year that changed, amended the income tax rates for this year, last year, and next year. And then guess what? It expires. You know, they pass these bills to give you benefits and then gives too much. And then when the next administration gets in, it's up to them to either continue it or change it or discontinue it or whatever, you know. It seems like that's been happening in the last couple of elections. But to start it off, I did give you a handout. It's basically taxes for the 2025 to 26 Beautiful Bill Act. Big Beautiful Bill Act. I kind of don't, you know, it's really a tax adjustment act. I don't know why they come up Big Beautiful Bill, but you know where that name came from. They're like saying it all the time. It's kind of like you don't hear about it anymore. It's kind of in the past now, but it's actually right now when I'm doing the taxes, it's really, you know, something that's really happening and it's really helping a lot of people. And I'll get in to tell you how it helps individual people that I already discovered and what it's going to do in the future. But what happened was on July 4th of 2025, legislation known as the One Beautiful Bill was enacted. And it's actually known as the Working Family Tax Code Bill, which actually that's what it is. This is one of the first things I've ever seen where working people are getting the bigger advantage than the levels up. And when I tell you some of these stories, you'll realize why. Because I've never seen this before. As soon as I did a few of these returns, and the people seen what they got, and this was early in the season when nobody ever comes, and I did a few returns, as soon as they found out they were getting this money, they started telling their friends, and I've been overrun, like I'm giving out free money or something. I can't even believe it. Here's my wife's here. I'm coming home at 2, 3 o'clock in the night sometimes, you know? I can't even sleep. It's just so busy right now. But what happens, it did, you know, it introduced tax cuts and changed the law that helps everybody. The tax cut passed, what happened was the last one that was passed was 2017. That was a Tax Cut and Jobs Act. It included significant changes to the tax code. However, when they were passed through Congress, this is what I was talking about, was temporary. So all the stuff that they passed back then was going to expire, leaving everybody pretty much out of the cold unless something was done. So what happened was the provisions were set to expire, and when they wound up passing this thing, the law turned out to do most of the changes will take effect January 1st, 2026, but some were retroactive on the taxes I'm doing right now for 2025. The people coming in now doing 25 stuff. So what happened was people don't even know. You're sitting here and don't even know you got a break maybe. I don't even know. But most of the changes were done for 26, but some of them impacted 25. Some of the stuff that impacts you right now, that some people know or some people don't know or kind of know. But here's one here, a big one. No tax on tips. You know, every time you go to a restaurant, you leave a tip or whatever, tip someone that winds up on a tax return. You know, if you're tipping someone on the check, it winds up 100% on a tax return. If you give them cash, it's up to them to voluntarily report that at the end of the night. I don't know if anybody here was a waitress or anything. Some places, like the big chains, sometimes have you sign something, cash chips at the end of the night, they put down 100, 150 or whatever, you know. The other stuff's captured on the cash register, so it's automatically reported. So what winds up happening is these people, no tax on tips, tip workers wind up getting a W-2 at the end of the year saying that they had, you know, they get paid something. They get paid so much an hour. They factor that in, which comes out to be small. Say it's like 2 something. I don't know if anybody knows what it is. Let's say it's $3 an hour, so they work 40 hours, they get $120 in regular pay, and then they add in their tips, which could be, you know, 300 a week or 400 or something like that. No one's going to work for less, you know what I mean? So it comes out to be pretty significant, and then as it hits the W-2, they take tax out of that, so that $120 they get like a negative check. They don't get any money back. And so some of the people pay estimated payments in, but nobody does that. None of them do it. Cashiers don't do that. I mean, waitresses, people get tips. No one pays estimated taxes. So what
Someone's
happens is
asking,
we
Charles, but don't you have to itemize then?
itemize them.
But don't you have to itemize then, is the question on Zoom.
Well, that's going a little farther down the line, but that's when you actually complete the whole return and either take the standard deduction or you itemize or any other deductions you have, childcare credit and all that stuff. But before we even get to that, you know, in spite of that, when I do the whole return, these people generally have to pay, you know, $1,000 or $2,000 at the end of the return or something like that, or they get nothing back. You know, the first one I did, the person had $28,000 in tips. And now they don't have to pay any tax on it. You know, some of it was withheld. And they had childcare and stuff like that. At the end of the day, when I did the return, she walked out with a $9,000 check from the IRS. Whereas in the past, she went up owing $1,000 or $2,000. So that's a turnaround of like $11,000. She was like so happy, you couldn't believe it, you know? But then I got a few more like that. Some even more money. I got somebody that cuts hair at one of these fancy hair cutting places where they charge like $45 for men's haircuts, you know. And then people get big tips to the people that made like $50,000 in wages, W-2 wages, and the tips that were on the cash register receipt, you know, wound up being like $50,000. So she made like significant money, and she was always paying a lot at the end. And what happened was no taps on tips. She walked out with like $15,000 back, where she was always paying $1,000 or $2,000 or $3,000, moaning and groaning. She has 2 kids and all that, so it was a big single. So it was a big savings for her. So she was super happy. She went into the cutting place, beauty hair cutting place, and told all the other people. And next thing you know, I got like 5 people calling me up for appointments right away. You know, where some of those people were avoiding taxes or not paying, or who knows, you know, I don't know. Yes?
So the tips are not reported as income, or are they
They're
deducted?
reported as income, but
But then you deduct.
they're deducted, they're washed out based upon these limits. So what happens is, you can deduct up to $25,000 in tips, and it phases out for taxpayers that are single. Once they make $150,000 a year, it starts phasing out. So really, not too many people make tips are making $150,000 if they're maitre d' at some expensive place or something, you know what I mean? And then, actually, if you're married, it's $300,000, so you're gonna get the $25,000, most likely, you know, unless something else is going on. And it's actually based on what they call modified adjusted gross income. It's not just your income. I want to explain that later on. It adds back stuff that you deduct. So just for the sake of going through this, and it's on here in a different couple of spots, and it's also done different ways and different things. They make it anything more confusing for taxes. You know, this is how they do it, to keep you like, pull your hair out, you know?
A question on Zoom, does that go on our joint return?
Yes, absolutely, unless you're filing separately or something like that. Yeah. The next thing that comes up is no tax on overtime. And, you know, because when you see W-2s and all that, you don't know what people are getting on overtime, you know, what's going on, you just see the figure. You know, so now, on box 14 on the W-2s, the employer puts down how much premium overtime you got. By that premium that's tax-free, it's not all your overtime. Say if you're making $20 an hour and you're getting time and a half, so now you're getting $30 an hour. That extra $10 is tax-free, but not the original 20. Follow me on that, sort of? At first, the people think, oh, $30 is tax-free, but it's only the premium.
The person who on Zoom who is just drawing on the slide, can you please undo those?
They're taking notes, maybe they're highlighting for us.
I don't know if I can erase that myself or not.
Wasn't me, Mark.
No, it's not, obviously not you.
Maybe
No.
it's, no, no. But at any rate, what happens with the no tax on overtime, it's the same thing. You can deduct up to $12,500 of overtime premium off your income. Could be husband and wife, each one could get it. In the event they don't actually put the overtime premium in now, what I see is the employers are giving people letters saying this is what the premium was based upon our payroll records. In the event that they don't do that, some people don't even do that, the employers, then we have to get the last paycheck that the people get. And if you ever notice, they have like the 40-hour pay and then the overtime pay. And then we have to manually like kind of figure it out, come up with what the premium was, make copies of it. And sometimes we gotta do a PDF and attach it to the return when we e-file it. Or if you're doing it yourself or mailing it in, you gotta give a copy because the IRS trusts you, who knows, but it's better to show them what you got so you don't get a letter like 6 months later asking you for the stuff. There,
You know what, I'm gonna unshare and then share it again.
Oh.
Go away.
So while I was doing that, let me ask another question. So those deductibles can be taken even before you work through your standard deduction?
yes,
Or
correct.
organization.
Right, it's called
Yeah.
like above the line,
Above,
above
yeah.
the standard return deduction before you hit the adjusted gross income. They're the best deductions. They're the ones that you want.
Okay, I was able to do it without stopping the share.
Good thing you know how this stuff works, Mark. And then the next one is, well, that, you know, like I said, you know, does have, if you make over 150 single, you know, you could be impacted where it phases over time. It phases out over the next so many thousands, where it goes down to zero. And the same thing for married. If you make 30,000, up 300,000, you don't have to worry about it. Or under, if you go over 300,000, it starts phasing out a little bit. Because they don't want people to make 300,000 to get the big break, you know what I mean? People were complaining about people who make $1 million getting a break, you know? Same kind of thing. People that make $1 million, everybody thinks they don't get breaks, but you know what? They have to pay extra all along the way. So it comes down to the wash if you really know what's going on. The next one is increased child tax credit. Now what happened is, for the child care credit, you get $2,000 for the whole year, each child. So if you have 5 children, you get $10,000. Well, starting in 2005, now you're getting $2,200. So you're getting an extra $200. So if you have 5 children, that's an extra $1,000. So now you're getting $11,000 cash, you know. So you wonder, like, how do some of these people live, you know, to have 3 or 4 children, you know? This kind of helps, you know. But, you know what, I always thought that how does this help? Because they get the money at the end of the year, you know, in the tax return. It's a lump sum, we're paying taxes. Or remember back during the pandemic and all that stuff, they kind of sent the checks. They sent the money to the people's bank accounts monthly. So they had access to it monthly. But then there was a big thing, they sent too much, you had to claw it back, you know. It was a big nightmare. So I don't know how you fix that, but I'm sure with all this AI stuff, eventually they'll be able to figure that out, and they should let send the people the money immediately, because what are you gonna do, wait to feed your child in April, you know, instead of monthly, way back January year before, each month? I don't know how that works. But, so that's a good thing. And then, the other thing was, here's a big one. I think everybody here, mostly everybody here is a senior, except for Mark. Trying to get there.
No
right?
comment.
But here it is, right here. Additional senior deduction for 25 to 28 for seniors. So it adds to your standard deduction an additional $6,000. So your standard deduction is $17,500, 17,000. So you add 6,000, so now it's 23,500. And if you're married, double that, you know? You're not gonna pay any taxes, seniors, you know? You're gonna have an almost $40,000 standard deduction right off the bat, an extra $12,000. You think this is helping people here? Think any of this stuff's gonna help? Most likely. This is showing up in people's refunds already that I'm seeing. And then when you throw in, you know, how like dividends, you know, if you make seniors, if you're like making under 70,000, the first dividends don't count. Interest, stuff like that. So you're not paying tax on that. Now you're getting the standard deduction, you know, another $12,000 added onto it. You know, you don't have to itemize. You don't have to come up with your income tax, your Pennsylvania income tax if you're still working, your real estate taxes, your church contributions, your goodwill, all that kind of stuff. Which when you add all that up, because you probably don't have a mortgage at this stage in life, but some people do, you know, it's hard to even get up to like, you know, $15,000 doing all that stuff. And now you're automatically getting $40,000 or whatever, depending on the situation. So that's a big thing, and that's retroactive, so that's happening in 25. The other thing is, you know, there's a lot of adoption going on there, so they actually give you like $5,000 extra for, you know, people to adopt. You know, it's been changing around over the years, you know. I think there's other monies from states and stuff like that you can get too, but they're trying to have people adopt people because the United States reportedly don't have enough native-born people, you know, so they want people to have children. And the reason they want to have people to have children is because they want the people to pay into Social Security when they get to be adults, because our Social Security is always paid by the current working people, not me. I paid in, so I paid my parents' Social Security, theoretically, and now my children are paying my Social Security. And when my father retired in 81 or 2, I think he was a high earner, and he got $12,000 a year, and by the time he died when he was 92, he was getting like $30-some thousand a year, because it just went up with inflation like crazy during those years. And he used to look at his Social Security statement and says, I know we're in trouble, the country's in trouble, I know where it's coming from, because he used to tell you how much you put in, how much your employer put in, and he would look at it and say, between the employer putting in and I putting in, you know, we put in under $100,000, and every 3 years I'm getting $100,000. How they coming up with all this money, Charles, you know? I'm saying, well, we're paying in. The rest of the people are paying in because the population grew and all this, but now it's going the other way. So everybody's worried how it's going to work. Everybody thinks Social Security might run out of money or something like that, but Congress, the government, they kick it down the road, the can down the road. You know, nobody wants to touch it because they're going to have to raise the amount they're taking out of the checks, and they're going to have to raise the amount. You know, it cuts off at like $135,000, and you don't pay any more in, unless you're really rich. Then you got to pay an extra $2,000 in 2% in for all your money. If you make billions of dollars, you got to pay 2% on that billions to pay in forever. You don't get any. You're never going to get any of that back. Another thing is, here's another big increase in state and local sole itemized deduction. Salt, I don't know, it's like something you put on your food. but it actually stands for state and local income tax. Now, for people who do itemize, this is where you used to be able to write off all your real estate taxes, state of Pennsylvania taxes, stuff like that, which was all right, you know? But then they capped it at $10,000. So that section of the Schedule A deduction was capped at $10,000. So you couldn't take out any more than $10,000. But what happens if you have a house down the shore, you know, and you're paying, you know, $7,000 of real estate taxes up here and $10,000 for down there, so now you're at $17,000, so you're leaving something on the table. And then your local taxes are like $4,000. You know, the earned income tax that everybody hates, Keystone, Berkheimer, you get my drift. And the state of Pennsylvania taxes, which is 3%, so if you're making $200,000, you're paying $6,000 there, $6,000, a couple hundred, you know, so now all of a sudden you're up to almost $20,000, you only can write off 10, it's like you threw away 10. What if you live in New York? The real estate taxes there are like, you know, $15,000 if you have a house. And what if you have a house in the Hamptons, you know, you're probably like, you know, $35,000, you know, so now you got like $45,000 tax, you only deduct 10, you're pretty mad, you know? So that was one of the things that when they were trying to pass this bill, they wanted to bring it back to like, to go down to do 20. And then they said they'd do it for 30, then they wouldn't pass the thing, they were gonna close the government down, all this kind of stuff. And eventually they settled on $40,000. So you get to write off $40,000 on your Schedule A for that kind of stuff. Real estate taxes, earned income taxes, and where local taxes and state taxes are sort of considered local for the definition of this. So it makes a lot of people happy. That's giving people sitting here money back, you know, theoretically, depending on how much taxes you're paying. Because, you know, when I moved here in '81, I think our real estate taxes were like $2,300, you know. Now I think it's pushing $7,000, you know. And then you got state of Pennsylvania and local, and you have a second home. It would cap out at 10. Now I can take whatever I need. I can take the full amount. Calls, don't you love them? Probably someone wants to buy my house or sign me up for a Medicare Advantage plan or something like that. The other thing is, this is something that, you know, nobody knows about. You know why nobody knows about it? Because it's no interest, I mean, it's deduction for interest payment on certain vehicles. So if you bought 100% made, or maybe it's 95% made, when you buy a car, if you're buying a car from a Korean place or something like that, it might be 100% made in Korea and imported in here. But some of these Korean places could be making them here, so it could be like 100% made an American car. In that case, when you get a loan, the interest is deductible. And nobody knows about it. So what happened is, we wound up saying that, it's in my stuff here. Some banks, where you have auto loans that originated in 2025, are sending people letters saying, you know, you had interest payment that you paid on a car loan that was originated in 2025, or 26, or 27, you know, which hasn't happened yet, but they should be sending these. So this person just happened to bring one in to me, you know. He said, I think I read something about, you know, you deduct this, you know. I said, yeah, if it's 100% American-made company, you know. And what it is, it has a little code here, where the VI, it has KMT, which means this was a Korean-made car. It was a Genesis, which is 100% imported. They don't make them here, you know. So they can't take advantage of it. But, you know, well, generally your Fords and all that, actually when you're buying these cars, but they didn't know too much of it last year to the end. But now when you're buying them, they're telling you, oh yeah, you get a deal, you know, all this. And, oh, by the way, you take out our loan, you know, you're going to be able to deduct the interest, you know, stuff like that. But you have to tell the person like me, because I don't know, you know. I'm trying to ask everybody, did you buy a car? You know, sometimes it slips by. Let's see where we're at on, here's another big one, especially here for people that have children, grandchildren and stuff. It is Trump savings accounts for children. Trump accounts are a new type of IRA for children. There's actually a form, 4547, it can be filed with your 25 return. So you come to me, or you do it yourself, or whatever, however you do your returns, and all you do is fill this one little measly page out to register for it. It basically asks the name of the child, birthday, social security number, and then what happens is they said that like anybody could open it up, but only one per child. So it starts out that the parents, if the parents don't open it up, we don't have any money, you know, all that kind of stuff, then the grandparents can open it up. And then it goes down the line, brothers, sisters, all that kind of stuff. But only one person can open up in a child's name. What this does is two things. For children that are born in 25, 26, and 27, the government's going to give them $1,000 right off the get. So it's going to happen during the July 4th, 250th anniversary of America. They're going to like shoot the money in. I don't know if it's going to be July 4th, but that's a banking holiday, so maybe the day before, the day after. I don't know how it works. But they're going to give them $1,000 to start off with. And then to get back to what I was saying about billionaires and stuff like that, people like Michael Dell and his wife, who are worth, I don't know, $80 billion or something like that, set aside over $6 billion that they're going to donate over the 3 years into these accounts. So they estimated how many people are going to sign up, which they think about 3 million people. But the people that are, you know, you don't have to be, you know, anybody up to 18 can get these accounts, but the only ones that get the extra 1,000 are going to get the, only the ones that are born between 25, 26, and 27 are getting $1,000 from the government. Other people will be your own people's money. And the way it's working is, for anybody under 10 years old, are going to get Michael Dell's money. So anybody born 10 years ago and up to now are going to get, if they turn 11 next year, they won't get Michael Dell's money, and they won't get the government's money anymore, but you know, the government's money's only for the three years, 25, 26, and 27. But Dell's money's estimated to be around $300 or $400 a year everybody's going to get. So now you're getting all of a sudden $1,400 for your kids out of the blue, you know. And then, like I was saying, all these other people started popping up. Ray Dalio and Barbara Dalio, hedge fund people in New York City, they pledged to give $75 million into these accounts. Brad Gessner, a billionaire out of Indiana, started with nothing, and now whatever he did, he was one of the first investors in Facebook and those kind of companies way back when. He's given $250 per child that live in Indiana, so you put it just in the state area. Nicki Minaj, the singer, is giving like up to $300,000 right now into these kind of accounts, but I don't know how that's going to divvy up. And several other companies are matching contributions. When the companies match it, they're usually matching whatever the government's giving, $1,000. JP Morgan, Bank of America, Acorn, which I don't even know what that is, Citigroup, and a bunch of other ones, Charles Schwab, BlackRock, SoFi, they're also giving matching up to $1,000. The bigger banks like JP Morgan and all them are giving $1,000. I don't know about Charles Schwab and all, but maybe, I don't know. And this list is just going to keep filling up. The real hope is that people like Warren Buffett, when they die, you know, because theoretically, Warren Buffett, whatever money, you know, he gave his kids are set, and he's still worth, I don't know, 100 billion, whatever, I don't even know. And he was originally gonna give that money to the trust that the Microsoft guy owns. And now they're gonna close that trust down in 10 years, so it might be 9 years, and it's gonna be closed down. So Bill Gates is gonna wind up with whatever's left in that trust, if he's still alive, I don't know where, or the money from Warren Buffett's not gonna go in there. So they're hoping that maybe a Warren Buffett will say, hey, my $100 billion, or maybe half of it, $1 billion, will maybe go into this kind of stuff. That way it throws the money all over America in one shot equally, and everybody's happy, and everybody thinks he's a saint. You know what I mean? You get the deal. And then maybe Bill Gates' money will go in. Maybe more and more people. Maybe people, like I was saying, that these wealthy people don't even take the income tax refunds and stuff. Maybe they'll start dumping it into here. So maybe, you know, these accounts will get 3,000 or 4,000 a year out of the blue. You know, who knows? You know, because you know the price of college and stuff today. You know, I think when I started, I don't even know what it cost. My parents, $2,000 a year to go to college in the '60s and '70s. You know, I think Villanova and places like that are like, I don't know if the tuition alone is 70 something, or is that room and board? Does anybody know? 100%. I don't even want to know, you know, thank God, you know. I have grandchildren, I think they're going to be, you know, whether like, oldest one's like 12, you know, I think they're going to be paying like, you know, 150,000 a year by the time they go to college if things don't get under control. But these are things you can do, and I encourage everybody to do it. Take advantage of it and talk to your kids. If they're gonna sign up for it, to start it, or use your name to start it, just to get the $1,000, you know, even if the parents aren't interested. Or maybe you're interested in giving them money instead of birthdays and Christmas and stuff, instead of giving them $1,000 that winds up in a video game, you put it in here and winds up down the road growing. And hopefully when they're 18, 19, 20, whatever, they don't have to take it out. You know, if it never gets spent during their lifetime, when they get retirement age, it can convert into an IRA. You know, so it's a pretty good deal. The other thing that really happened was the end of the electric vehicle credit. As of September 30th, there's no more if you buy an electric car. Which, if you kind of remember, that kind of like caused a breakup with Elon Musk and Trump, when that kind of happened, and, you know, I think they're friends again, I don't know. But that took a lot of, that was like $7,500. Why didn't they give the kids $7,500 in these accounts, you know, instead of that kind of stuff? But, what can you say? Here's another one, increase in the standard deduction. Well, besides, like right now, the single standard deduction for 25 is $15,750 for singles and $23,625 for head of household and $31,500 for married, you know? That was like staying the same. You know, if you were like doing your taxes, if you knew what was going on, you're always wondering, you know, everything's going up, but this 10,000 I get for the standard deduction never seems to go up, you know, but now it's, they put it in the bill. It's going to be going up every year with inflation. Kind of like Social Security, how it goes up. By the way, Social Security is the only pension that gets increased by cost of living. Well, there's some dispute on how they figure cost of living, you know, because when it seems to get out of control, they seem to go in there and tweak the figures. Oh, we're not going to count, you know, food, you know, or something like that. You know, well, everybody eats, you know, goofy stuff. But in spite of that, these things are going to go up. So if you get bad inflation like it was a couple years ago when Social Security went up 14%, that would have went up 14%. Additional items that really doesn't affect anybody, I don't think here was, but it does in a direct, indirect way. Now companies, as they expand, like if they put up a building, you know, they had to depreciate it over a number of years, like almost 40 years. Now they can take 100% of the write-off in year one. So that's going to encourage them to build and expand and equipment and all that kind of stuff they buy. All of this, you know, everything else they're buying that start up a business or expand a business, they can write it off right away. And you know what? That creates hiring and all the people that do the building and all that. which creates more Social Security going into Social Security, more taxes going into the government, so they don't have to bleed us, the seniors, so that way they can give us breaks. It just makes everything better, you know, down the road, hopefully. That's what I mean. I think this stuff maybe impacts some of the people here where it never did in the past. If I did this like 5 years ago with the bill, I wouldn't have anything to say. We would have been out of here in 5 minutes, you know? We wouldn't have had all this stuff. Ooh, here's a good one. 1099K issuance threshold has been increased. Now, anybody know what that is? That's for all the people that sell on eBay and Pinterest and online sales and stuff like that. What happened was, for years and years and years, you know, somebody can build up a business making like, you know, $1 million, and then nobody knew about it, you know, because they, you know, whatever they reported to the government, no one knew. But, you know, right around before the pandemic, they came out and said, oh, now we're going to issue 1099s for those people. And everybody threw a fit. Oh, and then they kind of like said, oh, delay it, kick the can down the road a few years, and then they started issuing them. So if you had like $600 in sales, like the normal 1099s you get, they were going to issue them. And then people were throwing a fit again. I don't have to tell you why. But eventually they settled on something saying that only if you have like 200,000 in sales going through these places where they issue something saying you made 200,000 or more, or if you had 200 transactions. So, you know, these little storefronts or barbershop that takes them, you know, maybe unless they have over 200 transactions on these kind of things, they won't get a K, 1099K. So they reported the old way, but if they're over that, then the government figures then you should have a county system, QuickBooks, you should be able to figure out accounting. You know, you're not operating out of the cash register to pay everything, you know, you should be able to do it. And hopefully they collect a better fair share of taxes. Other things are, this is one that hardly anybody knows about, but this just happened again, was everybody knows tax brackets, how they actually work when you do your pay your taxes. You know, once you get through your standard deduction and you come to the adjusted gross income, and then you take the standard deduction off it, then you get your taxable income. Well, if your taxable income is, after everything is done, say you made $50,000 and your taxable income is somehow of all these deductions, what happened is between, if you're single, say, married's a little double-ish, but, you know, between 0 and right now, $11,925, you pay 10%. And then the next money between $11,926 up to like $44,000, you pay 12%. Then on the next money, like at $48,000 to $103,000, you pay 22%. So at that point, you're in the 22% tax bracket, which is called the marginal tax bracket. If you hear that marginal thrown around, sometimes kicked around, that means the highest tax bracket you're in, the highest level you reached. So for some money you pay 10%, some you pay 12, and some you pay 22. And depending on how much you paid in 22, when you add everything up, all your income up, and all the tax you paid, you might have only been paying, you know, something like, you know, 12% in taxes, not 22. But for anything over 48,000, you're paying 22, up to 100 something. Then the next one jumps up to 24, 20, 32, 35, anything over 626,000. As a single person, you're paying 37% of your money out. Then you throw in Pennsylvania 3%, and then you throw in local, you know, anything else that might be hitting you. So that's how it kind of works in the end. But what they're doing now is the tax brackets will be adjusted for inflation in its range of income. For example, the top end bracket for a single will increase from 11,000 to 11,925. So it's going up even more than inflation. They're making all these things go up at the lower end. So the people that make the lower end of money, they're not only getting the inflation part, they're getting something extra. So maybe in 3 years from now, somebody, the first 10% will be like maybe cut off at, you know, it'll end at maybe 15,000. So the first 15,000 you're paying, instead of like the 11,000, 10, and then the next one was 12. Now you'd be paying 10% on 15,000, and it jumps and jumps. So it'll be taking less out of your pocket, you know. And that's how they did it in the past when they were raising the taxes. They made it lower. So they took money out at a lower level at a higher level tax. So this way it's going the opposite way, because they realize you can't live on, you know, in today's environment, you can't live on them taking money out when you don't make a lot of money. Everybody follows me there, I'm sure. So all these different things, you know, you have to like know about this stuff so you can actually plan, you know. So once you got it going, spinning around in your brain now, you know, you think how this is going to affect you, because I bet you some people didn't know maybe about these, you know, the standard deduction going up 6% for senior or 12% for married couple, or some of this stuff going on. Some of you had a return done yet or whatever, you're going to see how it starts impacting you in the future. So maybe you can adjust your withholdings if you're working still, you don't have as much taken out, or you don't have to pay as much estimated payments in, or somehow, you know, you don't have to get a big, you know, you don't have to get a surprise refund of $5,000 when you could have got it not paid in or something. So you don't have to wait to the end. You're giving the government a loan, you know. What if you don't live to the end of the year? You know, your heirs will be happy, but you won't, you know, you won't even have it. You know, earned income credit, you know, people get it. You know, what happened is this is encouraging people to have low incomes to actually work longer, harder, to make more money, because then they'll get more money from the government. And so they actually changed it to be a higher amount, and the amount you can earn to still get the stuff went up to like 60,000. Used to be capped at, I think, 40,000, 49,000 or something, so it went up significantly. Alternative minimum tax. Higher exemptions will phase out in 2025. I don't have to see below what that specifically is. But the alternative minimum in tax is what clips the billionaire people, 100 million, you know, people that make $10 million and stuff like that. Where all these stuff that I'm talking about just gets wiped out, and they just gotta pay the rate. They don't get all these deductions. They lose a lot of this stuff. They don't get any of this stuff in the end. It's called the alternative minimum tax. IRA contributions, they remain the same at 25, but the phase-out level has been changed around a little bit. So I don't know if people working here, a few are, maybe on Zoom, but the way it works is, you know, the phase-outs for making individual account contributions were current adjusted gross income, not the one that said an M on it, so it's a little different. That's what kind of tricked you up. For households between 79 and 89,000, for single and head of households, and joint returns 146,000 starts to phase out. For married, all these different ways that they figure it out here is phased out here, but you can look at that. That's one thing people kind of like look at when they do taxes, when they ask me, oh, how much more? Some people, the older you get, you try to save. When you're young, no one's saving, you know. The only people that I have saving in IRAs when they're young, when they first get out of college or out of high school, you know who it is? The people that actually have accounts? Young women. I have no men, you know, 25, 30, but I have women, as soon as they get out of college, they're opening up IRAs like crazy, or high school or whatever. They're savers, you know. They're thinking, you know, they have a different mindset. The men, beer money, no, or IRA, beer money, you know. maybe. So this is just telling you, like, you know, it's in effect. In addition to the stuff that kicked in retroactively to 2025, in 2026, a lot of this stuff's happening. You know, this elimination of personal dependents and exemptions, anybody know what they're talking about there? Remember when, you know, it used to be way back when, everybody here remembers this, younger people don't even know about it. But it used to be, the way people manipulated how much money they were getting withheld on their paycheck was they would go, well, I'm actually married and have 2 kids, and I'll deduct one deduction for my wife, one for me, and one each for my kids, so I got 4 deductions and married. So then what happens there is they give you more money when you put that on that W, used to be 4, I think it's W9 now or something. And then, you know, if you want to have more withheld, you said I was single, you know, with 2 deductions or no deductions, and they withheld more money, so you got a big refund at the end or something like that. Well, a lot of people don't know, in 2017, that went away. They're still on there, they're still on the tax returns, they're still around there, it's all over the IRS code and stuff like that. So people, even to this day, are saying, I don't know why I have no money, because I made myself single, I'm married and have 2 kids, and I said, that doesn't affect it anymore. They changed it where you had to actually go in there and say, withhold an extra $50 a pay period, or $250, depending if you get paid monthly or weekly or bi-weekly or whatever, to get more money withheld. You know, that's the only way you got more withheld. By fooling around that dependent stuff, it just doesn't even get inputted anywhere. You know, and the employer's doing a bad situation by not explaining this stuff to people, you know. But we try to tell them that stuff to the people, and you know what, it goes right over their head. You know, they just can't go back to their employer because they say, oh, I need to have like an extra $50 a week withheld, you know, because then they got to come up with the form, and then they got to send it to ADP, and, you know what's handling that stuff. So all that stuff's been eliminated. So now that won't even be like in the people's vocabulary anymore. That's gone. Well, the other thing that is made permanent is the way they're going to increase by inflation the standard deductions, the current tax brackets. They're going to automatically increase the child care credit. So they won't be holding the public hostage. Oh, we want to increase, you know, the tax brackets, or increase the child care. Oh, we're going to shut down the government if you do that. All that stuff's going to potentially go away, shutting the government down and fighting inbred in Congress. It's going to just happen automatically. So it lets some people off the hook that hate it, you know. Limitation on personal. It used to be yeah.
John, I might have missed this stuff for a second. The elimination of personal and dependent exemptions.
Correct.
Now-
Haven't been around since 2017.
Oh, okay. So
That's why they gave you the higher
standard
standard
deduction.
deduction. Remember,
Okay.
you used to get like 4,000 for each deduction,
Okay,
like that kind of stuff.
right.
That went away, remember?
Okay.
And when that went away, the only way you can increase or decrease your withholdings
Right.
was to do it by
Okay.
withhold more money from my check. Otherwise, they gave you a higher standard deduction, which is more to cover people that had 1 child or something, because they wound up getting a bigger one deduction. But people that had a bunch of kids,
Mhm.
they didn't have it. They kind of like lost out on it, because they would have had 10 kids, they would have got $40,000, you know?
Right.
Now they get nothing, you know, they get 15,000 or whatever, you know, depending on how it works out.
Okay.
But on the flip end, if they had all those kids, they might have been getting child care credit, what they didn't have before, and all
Right,
that, you know,
right.
I don't know. Different ways they made it up, but they kind of like eliminated it. They made it more understandable, so you don't have to do that Mickey Mouse stuff with the
Right.
withhold dependence.
Okay.
Yeah.
And one other thing, with the AGI versus the MAGI.
I'm gonna hit that in a minute.
Okay. Okay.
It's coming up. It's the grand finale. There's gonna be a pop quiz on it,
Okay.
actually. Ooh, I don't know. You know, you ride around, you know, you never would have known this before, but, you know, nowadays, you know, on that mortgage thing with the salt and all that kind of stuff, if your mortgage is over $750,000, you can't deduct the interest on over $750,000. So you have $1 million mortgage,
Yep.
the interest from 750 up is not deductible. You know, so if anybody here has a house in Hampton, it goes 22 million, you only can deduct the first 750 on that mortgage, or New York City houses, which would be a regular living house for $1.5 million, 2 million mortgage, stuff like that. Moving, limitation on personal casualty losses. Remember way back when, you say, oh, I had a flood and it cost me $2,000, and then all of a sudden it disappeared from Schedule A. You don't see casualty losses, but there was a way you could do it if it was like a flood, there was ways you could do it, believe me, but that's been gone, because you know what, that was pretty iffy, a lot of that was iffy. Because people have insurance, people would get insurance, they get paid $15,000 for something and then try to claim, and then the IRS would be fighting with them and all that. Because people at the IRS are like us, they know how stuff works, They go work at the IRS and see what's going on, then they work on the inside or they work on the outside and go to the IRS. So the IRS knows, they know what's going on. It's just how much they want to crack down, I guess. Ooh, estate tax exemption. Does anybody know how that kind of works? It's kind of like, and the figures are going to be off because I'm up to the 25 stuff, so it never comes into play hardly. But what it is if you're single, every person in here has, as of the old stuff, $12.5 million federal exemption on taxes. Way back when, 15 years ago, it used to be like 600,000. So if you died and you had $1 million, 400,000 was subject to almost 40% to the federal government. It was like a nightmare for people. And now, for a single person, it's 12.5 million. It's going up higher. Well, guess what? You're married. Each person has 12.5 million. One of you die first. The remaining spouse inherits that $12.5 million from the first spouse that died. So now they got $25 million. But if they have a farm, these farms around here, they're worth $2.5 million and they're farming it, they don't make a whole lot of money, so what if one of them died and the exemption was 600,000? How are they gonna pay the tax? They're gonna sell the farm. Up goes Toll Brothers, or whatever, So it like helps protect small businesses, all these factories and, 90% of the people in America work for not Google or Microsoft, they work for small businesses, people, less than 40 people employed. All these gas stations, garages, who specs your car and changes the brakes, who sells you tires, they're all small business, who restaurants, doctors, they're all small business, not huge conglomerates, So it helps those people, they don't have to sell their business when somebody dies. Plumbing supply companies, plumbers, have like 3 people working for them or something. All that kind of stuff. It makes it easier to continue on the family tradition. Or the other way, it was ripping apart the farms. Remember, they was doing stuff on PBS where the farmers were dying and the farm was worth so much that they had to sell the farm to pay the inheritance tax. And the kids are like, now if I was a farmer, I'd like, now what am I going to do? Become a computer programmer? Ain't going to happen. Do you know, anybody know what a qualified, if you have a business, you know what a qualified business is? And it could be a rental unit. It could be a store, it could be anything. It's an LLC. Does anybody know what that is? Well, the easy one to understand, if you have a rental unit, say, and the rented unit makes $10,000, the first $2,000 or 20% is tax-free, federal-wise. Does anybody know that? And or small businesses, stuff like that, LLCs. It's been going on for, I think, 4 or 8 years, stuff like that. County firms, doctor's offices, stores, gas stations. So it helps a small businessman. It ain't no fun being a small businessman either, you know, it's pretty cutthroat out there. It's pretty hard to make money because you gotta pay all up, you know, taxes, social security, employment taxes. And then, if you had a business or something like that, all the related business identified taxes began in like 20, all this stuff up there is like starting in 25, not 26. And then here comes the AGI versus an MAGI, modified adjusted gross income. What happens is when you do your income taxes, you're kind of paying taxes on adjusted gross income, which is what you see on your tax return. But then when you try to get some of these benefits, even like college stuff, tuition, scholarships, all that kind of stuff, because when you do your adjusted gross income, guess what? If you're an employee, you can deduct like an IRA. Say if you make $100,000 and you put $10,000 in a deduct for IRA, you're already taxed at $90,000. That's what shows up on your 1040 and your adjusted gross income. And then you can have other stuff like health savings accounts, all other kinds of little things, you know. So what that modified means is you have to, certain deductions you must add back. These deductions include the deduction that you got on your 1040 for IRA contributions, student loan interest, 1/2 of Social Security employment taxes, qualified tuition expenses, and more. So maybe that person that had $100,000, you know, their adjusted income was, I don't know, 80, you know, because husband and wife put in 10,000 each. So they gotta add that back in. So they're not giving away money for people that don't need money, you know what I mean? So they're making it fair. They can't spread it around, you know. Sometimes it seems like the government's giving out money all over the place, you know. But you don't get it. None of us get it, but they're giving it to someone, you know. Somewhere it goes.
Yeah, Charles,
Yeah.
that's a little confusing to me.
Yeah.
Like, in my particular case here, on my form, I have my total income,
Correct.
and then it says adjustments to income from Schedule 1, line 26. I don't have any of these issues here.
Right.
So is my total income the same as my adjusted gross
Well, you
income?
can look on your thing right here, I can tell you, like, you go to your adjusted income and work backwards, as long as you're not subtracting anything off.
No.
And then you gotta look at a W-2 to see if your W-2 said that you had like money deducted. Like, you know, the W-2 says you make $10,000,
Right, right.
but for Social Security, it says you make
Right.
$110,000 because $10,000 was an IRA deduction. So you
Right.
gotta go back, you gotta give that back.
Yeah, but I have none of that.
Probably not.
Okay, so they would both come out, they should come out the same.
They
then.
should,
Yeah, okay.
right.
And I don't have any additional income, and I don't have any deductions like contribution to an IRA. Now, I
Right.
can't do that anymore because I'm on my RMD, you know.
Right, right.
Okay, so that's the same then.
Yes.
Okay.
Right. That would be more for like probably working people. Here's what the
Right,
Trump
right.
form looks like that I was holding up. I don't know if you could see it
Um,
when I actually had it. And then, well, this is the form I was holding up that the bank gives people. It shows you they paid interest on a vehicle that you purchased, recently purchased. And then, you know, because I'm a tax preparer, you know, I like to just point out that when people kind of come to me, you know, we get 3 kinds of people that give us tax returns. So we get, you know, people that wind up giving us, you know, the stuff in an envelope. Pretty nice. Then I can keep it in the envelope, we don't lose it in the office and stuff like that. The next best people give us stuff like this. It's in a folder. And then some people use QuickBooks. They even use QuickBooks for personal. You can set yourself up like Joe Smith and key all your stuff in, your income in, and your expenses, just like your business. It comes out with stuff. I don't know if anybody knows that. A lot of people do that with their dividends coming in all, so they know where they're at, like this all the time, money-wise and all. But the worst people come in, they're called paper baggers. and they don't even open the stuff up. This is what I got. This is somebody's stuff. They gave it to me. It's not even, I had to open up the envelopes. You know, here is T-Row price. They don't even know what's in there, so they just hand me the stuff, statements. And then we gotta open it up, and figure out what's going on, but in the back of my mind is, so many people have a lot of money and stuff, and I'm wondering, do they even know what they're looking at, what they're getting? You know, but it takes a lot of time and pain in the neck, you know, to do this stuff. You gotta make sure we don't miss something and all. But we like to know, that people know what they have, you know? I mean, you would think, but it's pretty weird how some people don't know. Well, that's about all I had. If anybody has any questions, I'll be glad to entertain them.
Okay, thank you. Anybody on Zoom would like to, or any in the room? Go ahead.
With being retired and you have pensions coming in, so
Right.
that's your income coming in, that's what you got.
Right.
And then when you're over 73, I have to take.
R&Ds.
Right, so
Right.
then is that together?
You're not over 73, are you? It doesn't happen to you yet, did it?
He's my neighbor, he knows better, quite a bit over. But,
Right.
so that is my income then, the RMD?
Correct.
For the both of us, and then what both of our pensions?
Right. Well, it
And-
depends,
Depends.
because the income from probably the pensions you're getting, right,
Correct.
are taxable for the state of Pennsylvania.
Well, mine isn't, because I'm a teacher.
Well, the teacher ones is the money that the school district put in and never taxed you for.
Oh,
But maybe with your husband, if you had a 401k,
yep,
the 401k was deducted, say you made 100,000 and they put 10,000 in, the taxable income for the federal government was 90,000, and for the state it was 100. So for the state, you never pay tax on it, so you gotta pay tax on that. But for the federal government, you put in
mine. You said-
before tax income, and they strike it, now you gotta pay tax on it. Or not tax on it because they deducted it. Or they did, no, I'm sorry, I'm in reverse. They deducted it, the 401k,
Okay,
the 10,000 every year that they put in came off his income. So now when he gets the money out, he's getting a 1099-R that shows you that it was taxable. There's a taxable box, one, how much is taxable, two. It's gonna be like the same amount he took out in both boxes.
but you have to add that in with the R&D money too.
Yeah, well, you add all that money up, you could take both your R&Ds, so he's gotta take out 30 and you gotta take out 30.
Okay,
You know, if you took out 40, he's only gotta take out 20, you know?
or whatever.
And you can take it out of one account, all your accounts, you know?
Oh,
Yeah.
So for this, for his, he doesn't have to take out the amount that it says that Schwab says you have to take out,
You have to take out the amount for his as an individual.
okay,
But he could take, if he has 5 accounts, he could take it all out of one account or,
okay,
you know, per percentage or something like that. You know, some people have small accounts that they just let ride, or they just clean them out one year and then take balance out. You know, some people take a lot more out, you know, than they even need.
so if you combined your with the R&Ds and with the pensions, then you won't probably qualify for this, whatever you said on the front, that the ton.
Well, you're a teacher, so all your pensions are gonna be taxable. And on his, you know, depending how he, you know, how he put it in, did he put it in before tax or after tax, or did some of it was Roth? You know, Roths came out in our era,
Right,
like 15 years ago, and it wasn't available in 401ks. But maybe 10 years ago, it started popping up in 401ks, so people have Roth, ones which you don't have to take anything out, theoretically. But it just depends on what's on those statements. But most likely, all your teacher stuff is gonna be taxable, and probably most likely, all his stuff's gonna be taxable, but not for Pennsylvania. But probably your pensions might be taxable in Pennsylvania, I don't know. I don't know, but maybe not, you know, depends on what the situation was on the form that they give you. You get pursers, right?
Yep.
Peasers, I mean,
Yeah,
peasers,
yes, here is,
right?
you're a teacher too?
yeah. Recovering, yeah.
It
There's
looks
a,
like you're still working, or is that just nothing? That was just your income tax return. I didn't know
No,
you had
that's,
salary on that.
no, that's why I asked that question.
Oh,
because
oh,
I don't
oh,
have
yeah,
any
right, yeah,
additional
right.
income or anything,
Right,
you know.
right, right.
There's a question on Zoom. So we can't claim interest on a purchase of a new vehicle if we paid in cash and did not get a loan?
Unfortunately, yeah, you don't have interest, you know?
Yeah,
You have negative interest, you know? I mean, you have benefit that you can pay interest. You save money. The deduction of not paying the interest is better than having the tax deduction. Because if you had $1,000 in interest and you're a 20% tax bracket, you would save, you know, $1,000, you would save $200 on taxes. But if you went up paying cash, you know, you save all the interest of the 6% loan, you know, depending on how big the loan was.
Oh, okay, I was thinking the tax I paid. That's the comment.
Like the, yeah, the purchase tax.
I was thinking the tax I paid.
No, it's the interest.
It's the interest, not the, yeah.
Interest loan. What they're doing is trying to encourage you to buy American cars versus going to buy BMWs made in Germany or something, you know, all these imports, you know. Because everywhere you look, there's imports, but now it's hard to know where imports come from.
right. And the parts come from everywhere
Yeah,
also,
right,
you
and
know.
it's even
Yeah,
worse,
right.
right. You don't know where parts, well,
Exactly.
what happened was when they first got involved in all this kind of stuff 20 years ago, with tariffs and all this kind of stuff, you know, they said like Germany, in order to, you know, get around the tariffs, so they're gonna build all the stuff in Tennessee or somewhere, you know? And they used to build everything. They used to build the engine, transmissions, all the parts, have them stamped out here. Maybe the tires, maybe not. You know, everything was built here, you know? But then they started cheating, you know? They started sending over the engines that were built in Germany, which is the money, you know? Then they started sending over the engines with the transmissions attached to it, you know? Which is like $5,000. Then they started sending over body parts that they stamped out there, you know? So all the people down in Tennessee were just assemblers, you know? They weren't
Right.
like manufacturing machine shops and doing all the work, you know? So it was losing all the labor, you know? Because the labor, everybody, in Germany, you know what Germany is?
High pay.
Yeah, but you know what they do? They manufacture cars and sell them all over the world. They really don't have nothing else going on, hardly, you know what I mean?
Okay.
They're a manufacturer of cars, and they do everything, you know, just like Japan does.
Yeah.
Japan does make them here now, but you think they wanted to have them made here? That was killing them. You think China wants to make cars here? They're gonna make them in China and put their billions of people to work. They don't want to have them here working, you know?
Although BMW does outsource to South Carolina.
Yeah, but that's where they used to make everything there, but, you know, they were shipping in all the parts already made, they were just assembling them.
Right.
You know, they used to make everything here in Subcraft, but all the plants that were doing the engines and the machine shops and all that kind of stuff, and the stampers, like Bud, remember Bud?
Oh, yes,
They
yes.
stamped all the body parts. Where's Bud?
Right,
They were all over here, remember, there's one up in Lancaster, there was one
Right.
down the Turnpike, Huntington Park.
right.
Philadelphia was like the biggest plant in the world, you know, around, and
Mhm.
they're all gone, because none of these places are stamping stuff
Right,
for all these cars being sold, you know, because they were sending in the parts. That's what Canada,
yeah.
Canada was doing the same thing. When they originally were allowed to make the Chrysler stuff, part of the deal was they were still gonna buy the parts from here and kind of assemble them, and the next thing you know, they're a full-blood manufacturing plant, and all the people from Detroit are losing their jobs. You know, the jobs are what's valuable nowadays, you know, it's not
Right.
the other thing. It's a fight over jobs. Look what's happening in America. It was like jobs are disappearing, you know. Now they're trying to, pharmaceuticals, remember pharmaceutical places all over here? And then they all of a sudden disappeared. Now they're trying to come back.
Right.
Because they want the
Any,
jobs here.
any further questions from anyone?
Yeah, I was, a punishing one,
Yes.
residential energy
Oh.
credits, oh,
Let that person on Zoom go first.
oh, I'm
Is that
sorry,
right?
okay.
Go ahead on Zoom.
Hi, can you hear me?
Yep, we can.
Hi. I'm sorry, I couldn't make the meeting. I wanted to come, but I'm very sick. I have a question about Roth conversions. I don't know if you went over anything like that because I joined late.
Right. Yeah, Roth conversions are still available.
Well, my question is, I have a small pension, of around $30,000 that's being held by the company that I used to work for, GlaxoSmithKline. So if I roll that over into, also have a small traditional IRA. So if I roll that pension over to the IRA, they're not going to tax it. But if I roll it over to a Roth, they're going to withhold 20%.
Right.
Right.
Yeah.
Withholding's not necessarily the tax you're gonna pay, it could be significantly more or significantly less.
How do I know? First of all, if I convert that immediately to a Roth, I should have over the years converted these things slowly, year after year after year, but I didn't do that. They would have all been converted by now. But I had to move, and that kind of upset a lot of things. So if I take this pension, put it in a Roth, is that the same? How is it taxed? Is it considered just adding $30,000 to our adjusted gross income?
Correct. So how old are you, by the way?
I'm 70, so I'm not withdrawing anything out of my little traditional IRA yet.
Well, the thing with these Roth conversions, which you see advertised every 5 minutes on TV and Facebook, go to seminars for Roth. I used to be at Morgan Stanley. I retired from Morgan Stanley when I was 55. And, you know, that was a topic to get people involved. And you know what, it was different back then because everybody was younger. Now people are 70 and stuff trying to convert this stuff. But what happens is, if you have $100,000, just use a simple thing, and then $100,000 you're probably paying, you know, maybe up to 22% of the money you're putting in. But just for sample of illustration, so I got $100,000 that is still in the IRA, and then I want to take that $100,000 and convert it to a Roth and pay 22%. So now I'm going to wind up losing 22%. I'm going to pay it to the federal government. And so what's going to happen is now the Roth is holding 100,000 less, 22%. So now it's $78,000. Now the market, it's vested in the same thing. Say the S&P 500 is going up 15% on average. On average, but not every year, 15% over the last 15 years. Even more so over the last 10 years somewhat. So in year one, your IRA is now worth $115,000, and your Roth is worth $78,000 times 15%, which is approximately, I don't know if anybody can do the math here. Well, 10% of $78,000 is 7,000 something, and one half of that is 3. So now it's 10,000. So your Roth is now worth 10, and your IRA is worth 15. Now it starts compounding out. So the money that you're withholding in your regular account is compounding out at a higher level because you didn't pay tax on it. And the Roth's compounding even at the same percentage, but it's on a lesser amount. So, how's that work out? I don't know. Especially someone that's 70 years old that has a life expectancy as a woman of like another 15 years, you know?
So at this point, it's...
I don't know. You have to sit down with somebody. It's going to take your 1040 for the last couple of years and look at it and compute these things out to see if it makes sense. You know?
Yeah, I don't honestly even know what tax bracket we're in, how much tax we pay.
Right.
My ex-husband lives in Delaware and he files a joint return down there. I kind of was hoping if they held 20% of it, that I
may or may
get
not
some
be
of that
right,
back.
but you're throwing away 20% to taxes. It's not going to compound in the other IRA when you take it out, and you'll have more, even though you're going to be paying tax on more. It's kind of like, well, I work 40 hours a week and make $1,000. I don't want to work 45 hours because I want to pay more taxes. Yeah, but you know, your net on 100,000 in a year is say 70,000. If you work 45 hours, your net's going to be, you know, 45, you know, 5,000 more. So you still got more money in your pocket, even though you pay higher taxes. You know, I mean, it's still more for you. You know, it's kind of the same thing with these IRA conversions things. But somebody's got to sit down and take the information off your 1040 and then work up the scenario I did with 100,000 and then paying the tax and seeing how it grows. There's people out there that do it. I can recommend some people to you.
Yeah.
You know, I used to do it, but you know what, because I do this now and I'm older, I defer to like people that I know that are in the business that do this all the time, that have the
Well,
computer
you know,
programs.
some of the benefits, you know, like if you pass it on, then, you know, the person who you passed it on to doesn't have to pay any taxes. So there are
Yeah,
benefits
but
to
you're not
it.
around, it's not benefiting you, you know?
Yeah.
What if you live to
Well,
be 70, what if you live to be 85 and you deplete all this stuff, so you just didn't make enough money out of it, you know? You might have to draw on it, you might draw it down. What if you go to a nursing home, you might need the money, you know? Versus that 20% you wound up giving to the government, it might have been 22%.
Right.
Could have been higher, probably less, but I don't know, you have to do it against your income tax return to find the exact figures out.
Charles, would
I-
she be better off just go right into moving the money into a traditional?
Well,
Therefore, she's not
Yeah.
being any,
yeah, same thing, but you won't be getting it tax-free when you take it out. thing.
right, but you're gonna be paying at a lower tax bracket.
Well, it's either if it comes from a 401K or traditional, it's gonna be taxed the same way. There's no difference. The reason they want you to roll it in an IRAs when it's in a 401K is because the company that has the 401K,
Yeah.
Glaxo, is paying the fees on that. You know, so if you look at Glaxo's, you know, financial statements, you're gonna see they have billions of dollars in 401Ks that are paying a fraction of a percent on it, but it amounts to be hundreds of millions of dollars. So if they get rid of 50% of the people to get it in IRAs, they pay 50% of those hundreds of millions of dollars, you know? They want that out, so that you have to pay the fees to have this stuff done. You know what
So
I mean?
I should have converted it little by little over the years, and then you don't
Probably
take
would
much
have
of
made
it.
better sense when you were younger, but I don't know if you want to bite the bullet, you know?
That's what I want to find out, because I thought maybe I will just bite the bullet and convert the whole thing at this point, because I'm 70 already. But I need somebody to help me figure
Once you
out
convert
if
it,
it's
start
worth
drawing it
more.
out at that age, yeah, once you're 70. But the idea is, if you do convert it, then you don't want to withdraw it, you want the compound tax-free, you know? So you want to stop taking money out of that, and whatever you didn't convert. You know, if you're going to convert it and start taking money out, I think it's a pyrrhic victory. You know, what did you do? You shot yourself in the foot, maybe. That's why you got to have somebody take your 1040 and work a scenario up. They can tell you
Yeah.
definitively,
I
mathematically,
think
how it
they
works
tell
out.
you not to take anything out of it, you know, for like 5 years.
Right.
Do you know somebody that can look at my tax return and help me figure this
Yeah,
out?
look it up. Look me up. On Main Street in Phoenixville, Wilfong.
You should have had received the handouts with his contact information on it that I emailed earlier today.
All right, thank you.
Yep, thank you.
Cost, yeah.
Okay.
Any
That's
last questions before we wrap this up?
Yeah, I had one on residential energy credits.
They're
which has
still
always been-
available, it's scaled down.
Yeah, but I had one particular item here. It mentions here, enter the qualified manufacturer
Yeah, right, it's a
identification
pain
number.
in the neck.
Right, but here's the issue. They're talking about, let me see, I just had it and I lost it. Okay. They're talking about the most expensive natural gas, propane, or oil water heater.
Right.
Now, when they say oil water heater, they also mention another one, hot water boiler.
Right,
Either
that's
one
the
of
old
those-
houses where they had the old,
Okay, but
things.
that's not your traditional holding tank. You know, where you get hot and cold water from.
no, that's not your
Okay, what am I?
hot water heater.
Yeah, that's not a hot water heater what they're talking
No,
about.
that's the big thing in your basement that your grandparents had.
Oh, okay.
They used to
okay.
go bang, 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 and all that
Okay,
kind of stuff, and they
okay.
were already like steam and all that.
Alright,
Had
and
the,
so all hot water heaters are off the table. I
right,
mean, okay,
right. They used to be on the table, but you only got fractions. Right now, the most you get out of these things is like 600. We used
Yes.
to get like tons of money in the past, you know.
right, but you could not list it as, okay,
No,
okay, thank you.
no. Sometimes, you know, check Pico and all that. Sometimes they give you money for doing stuff like
Yeah,
that.
yeah. Sure.
Different places.
Okay, any last questions? If not, thank you so much, Charles, and thanks
Yeah,
everybody
thanks,
for
Mark.
coming out
Thanks
and
for
Zooming with
hosting.
us
Mark.
today.
Thank you, Mark.